Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about buying versus renting your home. So here recently I've come across a number of influencers that are talking about why you should rent your home as opposed to buying it. And why would you want to tie up all of your capital in the purchase of a home when you could potentially be investing that in something that might make you more money. So in today's video, I'm going to be walking through a side-by-side comparison of buying versus renting. We've got lots of numbers here today, so we're going to get into some detail. That's why I've got my index card. And what we're going to be looking at is a $500,000 hypothetical home rental or a $500,000 home purchase. So let's start over here with the purchase side of things. And so if you're looking at a $500,000 home, remember, one of my rules of buying real estate is that you always want to put at least 20% down. I'm not going to get into all the details there, but that would be $100,000 for this example here. And if you don't have $100,000, then you probably shouldn't be buying a $500,000 home. You should be looking at something that you can afford, or maybe just jumping right ahead over to the rental side of things. Okay, so after deducting $100,000 from your purchase price of $500,000, obviously that means you're going to be borrowing $400,000. Now, if we assume that you're going to get, let's say, a 4% mortgage on that house, and let's just say that you're going to do a 30-year mortgage, so 360 monthly payments over the lifespan of that mortgage, if you keep it that long. We can talk in another video about 15-year mortgages versus 30-year mortgages, but at 4% interest, your monthly payment on that is going to be $1,909 per month. If we multiply that by 12, that means your total cost of just the principal and interest on your mortgage, if you make those minimum payments, is going to be $22,908 for the year. Now we know, because we've talked about this in other videos, that owning a house has a lot more expenses besides just the principal and interest on your mortgage. Some things that you're going to have, obviously, you're going to have some property taxes, and that can vary wildly from one area to another depending on where you live and what cities and states that you might be buying this house in. But we're going to just say as a rule of thumb here that your property taxes are going to be 1% of the value of your house. So in this case here, we're going to say that that's going to be $5,000 for the year for property taxes. You're going to need to buy homeowners insurance, and again, that can vary by the area and your individual situation, but we're just going to make things easy. We're going to say that that cost of insurance is going to be $1,000 for the year. And then you're also going to have some maintenance, and we've talked about this, and you don't want to get surprised with these unexpected things that could come up, dishwashers breaking and roofs that need to be replaced and paint and things like that. So again, that's going to depend a lot on the house that you're buying, how old the house is, how old some of the mechanicals in the house are, and some of your appliances and things. But we're just going to say 1% of the value of your house, so we're going to say another $5,000 for the year for maintenance items. So when we add all of that up, that comes out to be $33,000. Trying to write sideways here, doing my best. $33,908 for the year. So that is our cost, and if we divide that out by 12, that is going to mean that our total monthly expense for that house is $28.25 per month. Okay, so now if we talk about the rental side for just a minute, we're going to jump back over here. We're going to look at some other things as well. But according to smartasset.com, they estimate that what you could expect to pay for rent for a typical home would be between 0.8 to 1.1% of the value of the home. So if we're talking again about a $500,000 purchase, that means that if you're at the 0.8 side of things, you might be looking at a monthly rent of $4,000 per month. If you're up at the higher end of that, 1.1%, it's going to be maybe as high as $5,500 a month. So right off the bat, it appears that owning the house is going to be, much more advantageous. Your cost of everything all in, including those taxes and insurance and things, is $28.25 compared to, even on the low end of renting that house, could be about $4,000 a month. But let's start looking, make sure we compare apples to apples. We include, be fair to both sides of this. So one of the things we have with the purchase side is we had to put that $100,000 in. So again, one of the arguments that some of these influencers are making about why would you want to tie up $100,000 when you could be investing that in something else. And so again, it's going to depend on what type of investment you get into and obviously what's going on with the markets or whatever it is that you buy. But let's just say that you invest that $100,000 and maybe you make 5 to 8%, just as a rule of thumb. So 5 percent to 8% per year. We'll kind of settle in on an average just to make the math easy there. Let's say if you made 6%, just doing some simple math, 6% of $100,000 would be $6,000 divided by 12 means that your actual cost, if we include the kind of the missed opportunity cost of investing that money as opposed to putting it in our house, would bring that up to $33.25. Again, trying to write sideways there the best I can. Okay, so that gives the cost up a little bit, makes it a little bit closer to this. So now let's talk about this and what are some of the other advantages potentially of real estate. We've heard a lot of people talk about real estate here, and there's actually 4 significant advantages that are going to, I think, make buying the house a little bit more advantageous versus renting the house. And one of those is going to be appreciation. And it depends on the area, but if you kind of look at what we think most houses are going to do over time, is we think they're going to probably keep pace with the rate of inflation. So if inflation is 3% a year, then you might expect that your house is going to also increase by 3% per year. We're going to use for this, we're going to say, let's just look at a 5-year outlook for this, and most people tend to move about every 5 to 7 years anyway, according to a lot of the studies that are out there. So your $500,000 home over 5 years at a rate of 3% per year means that house is going to be $579,637. Again, this is going to depend on the area and what's going on with the local real estate market and what inflation is going to be. So when you go to sell that house, you could be looking at a potential profit of $79,637. But we know that there's some expenses usually involved with selling a piece of real estate. One of those is going to be real estate commissions. Depending on the area that you live in, there could also be some transfer taxes and everything. But we'll just do some simple math here, and let's just say that you get to keep 92% of that profit, but that means that you could be looking at about $33,266 in profit on that house, even after paying maybe a 6% real estate commission and a couple percent for transfer taxes and anything else, title, insurance, and things of that nature. Number 2 is going to be the principal that you're going to be paying off each month as you make that $1,909 monthly payment. So over the course of 5 years, if you just make those minimum payments, the $1,909, you're going to have paid off, your mortgage balance, I should say, is going to be $361,790. Okay, so remember you put you borrowed $400,000 originally, and now you only owe $361,790. So that gives you a net principal reduction of $38,209. Okay, so that those two added up together mean that you've actually improved your situation by $71,475, and if we divide that by 12, that works out to be about $1,191. So, again, so that's going to be more favorable for the purchase side of things. And if we subtract $1,191, that's going to be down to about $2,200 or so that your actual cost of ownership is going to be. There's actually a couple more advantages of buying a house. Number 3 is going to be the tax deductions that you're going to get. If you're itemizing your deductions on the house, you get to deduct your mortgage interest. So in the case of a $400,000 mortgage at 4%, that might be as much as about $16,000 in interest deductions that you get to take off of your income tax, off of your tax return for the year. You can also deduct your property taxes as well, which in this example we said were $5,000 for the year. So keep in mind a couple of things. There were some changes with the new tax laws that went into effect at the beginning of 2018. One of those changes was they have reduced the amount of what they call state and local taxes that you can deduct, capped at $10,000 for the year. So in this example here, it fits into that. But again, if you have some local income taxes or state taxes that might be part of that, keep in mind that you may not necessarily get to take the full advantage of that tax deduction. And they also put a cap on the amount of a mortgage that you can still still deduct the interest on it now. That's at $750,000. So again, in this example, we're still underneath that, but again, it may not necessarily hold true if you're borrowing, let's say, $1 million in a mortgage. You may not get to deduct all of that. And then the fourth thing is actually kind of my favorite here, and that is that real estate is inefficient. What that means is that unlike the stock market, where if you want to buy Apple stock or Amazon stock, there's literally, tens of thousands or millions of people that are all bidding on that stock every single day, kind of determining the value. But if you go into a neighborhood, and especially if you're maybe looking at a house that may need some paint, and maybe some people that are going in to look at that house can't get past the fact that this house needs some work, you might be able to buy a house for less than what that house is actually worth. So you might be able to go in and buy a $500,000 house, maybe buy it for $400,000, maybe it needs $50,000 worth of work, but even after putting that $50,000 into the house, you're into it for $450,000 as opposed to what the other houses maybe in that area are selling for, which would be $500,000. So you might have another capital gain there. And speaking of capital gains, home ownership is actually one of the best tax advantages that exist within the IRS tax code. So as long as you've lived in a home for at least 2 years and it's been your primary residence, you can actually have up to a $500,000 capital gain and pay zero income taxes, zero capital gain taxes on that. And that is really, I think, one of the best features of buying a house. So anyway, I hope that gives you kind of a good idea. If you're looking at an area and maybe you're not sure how long you're going to stay there, maybe if you took a new job transfer or something and you don't know if you're going to be in the house real long term, it might make sense to maybe save that down payment money and maybe not get tied into a real estate transaction that you don't know whether or not you're going to be there for very long. So rental experience could be good for that type of a situation, but for most people, if it's going to be your house and you're planning on living there like most people do 5 to 7 years, I think you'll probably be better off to buy your home as opposed to renting your home. So anyway, I hope this has been helpful. I hope you got some great information and great value out of the video here. Remember, if you like it, hit that like or subscribe button. Make sure to check out the description below for links to some of our other content, playlists that might be able to help you out there. So with that, I'll see you back in one of my next videos. Thanks.